Welcome to our Thursday webinar series curated by Andrew Joseph, PR for Aspire Design and Home Magazine. Today, we have a very timely and interesting talk with the lovely ladies from the Wingnut Social, Natalie, Grafe, and Darla Powell. If you don't listen, tune in for their short mini version on Mondays and the longer version on Wednesdays. It's always educational and highly entertaining because once you start listening to these ladies, if you haven't already, they're quite fun. You're paired with Erin Smyle. I wanted to call this webinar Death and Taxes, but in the age of COVID, it didn't seem right. But Erin has a unique ability to really make taxes and finances accessible and easy, and I would even say sexy. So with that said, I'm going to turn this over to the panel and enjoy, edify, and have a wonderful day. Thank you.
Thank you, Andrew, and thank you, Aspire. And thank you, Aspire, for having Natalie and myself here. So like Andrew said, my name is Darla Powell. I am the head Grand High Poobah at Wingnut Social, which is a social media marketing agency for high aesthetic brands. And we do have the Wingnut Social podcast about social media and marketing. And I'm joined by my emotional support ginger, the soulless ginger, the nag, Natalie and Grafe.
I just sit here. That's really all I do.
Pretty much.
Yeah.
But she's the money girl here. So she's got some questions today for Erin. And yeah, if anybody can make taxes sexy, it's Erin. I mean, come on, take a look. Pocket square.
A lot of pressure. A lot of pressure.
Look at that nice, neat pocket square, all dressed up today. This is good.
Yeah. So I love
only the best for you guys.
I love that Andrew said death and taxes, because didn't we come to the conclusion that that should be the hashtag on your tombstone at the end of your
You came to the conclusion that yes, I had something that wasn't as clever, and you certainly made it a little bit better.
Awesome. Well, we're so glad you're here because let me tell you, especially in this year with the PPP loans, the forgiveness, all the tax situations, I know it might not be a sexy topic, but it's a very important topic and people do want to know. So we want to start in, I guess, with the most pressing issue, right, that people need to be paying attention to, which is the PPP loan, the forgiveness portion, because I think a lot of people are under the assumption that once they've done it, it's just kind of an automatic thing. They're going to be forgiven and the hard work is already done. So I think we should launch with that.
Yeah, like where exactly, how do we do it? Like from A to Z, like it's simple Amish style here. Like, do we got to log on?
Do the Amish do taxes?
Oh, that's a good question.
Yes.
No.
I believe that the Amish are not, yes, Amish do taxes, I would say. It's not easy to apply for the forgiveness. We're still waiting for additional insight. There was talk about loans up to a certain amount will automatically be forgiven then that would be very easy.
Okay.
However, that hasn't come to yet. So right now, all of the forgiveness is being coordinated essentially and being applied through with your bank. So whatever bank you applied in order to get the loan with, that's who's going to be managing your forgiveness.
Okay, that makes it easier.
It makes it easier because they have your application. When you initially put the application in, you indicated what the payroll costs were, that you typically were banking with them. That was one of the earlier requirements. Towards the middle and end of all the applications, there were certain banks that were just accepting applications even if you weren't a customer. So all of the documentation has to be in order. All the documentation is going to be bank statements. It's going to be payroll reports for the period that you're looking for forgiveness on. If you're including rent, you're going to have canceled checks for rent. You're going to have canceled checks for utilities, all of which are approved costs. Additional legislation came out saying that the split of what could be used for forgiveness is now in a 60-40 manner. 60% has to be used for salary and 40% can be used for non-salary. The non-salary costs.
That changed, right,
It
originally?
Did change.
Yeah.
It did change.
Okay.
So initially there was a higher requirement for salary. They brought that down a little bit. Partly because I believe that they recognized that most businesses weren't open and having to have that additional burden of paying that much in payroll may be difficult. So again, they brought that down to 60%. you're going to have to do some calculations as well. So it won't be simple. A lot of payroll companies, I've seen it with ADP, I've seen it with Gusto, they are on the back end preparing a lot of these calculations and schedules for you. So one of the requirements is that you don't have a reduction in headcount and you don't have a reduction in total salary paid. And some of these payroll companies, again, are doing it on their own and coming up with these schedules for you that you will be able to provide for forgiveness.
Let me ask you really quick before we move on from there. What if you have an addition in headcount? Is there an issue there?
You're allowed to have more.
Okay.
There is no requirement on having more, but you can't have less.
Got it.
You are allowed to pay individuals less, but only a 20% reduction. So just to keep it very simple, if somebody was making $100,000 annualized, you could pay that same individual $80,000 annualized, and there won't be a reduction in the forgiveness. If the person that was making 100 was let go, you cannot then bring somebody on at 80. So you can't replace them with a reduction of salary. You can only have a reduction in salary in current employees.
Okay.
Makes sense.
Okay. Okay.
Perfect sense.
I think I have my head wrapped around that.
Are you sure?
No. So hashtag Wingnut. So Natalie, please follow up with a question, Natalie.
So if we're going to go ahead and apply for this and we're going to go ahead and get this done, then how long are they saying how long until you're done? I mean, is this going to affect our 2020 taxes? I mean,
it has the potential to be a nightmare actually for 2020, unsurprisingly. So
imagine that.
The two, the forgiveness portion where they increase the salary up to 60% of what you can borrow. They also extended the period of forgiveness which you could look for. So you either have an 8-week period that you can use costs for, or you have a 24-week period that you can use the costs for. Now, there is no in between. So you either choose the 8 weeks or the 24 weeks. The biggest stipulation is that at the end of each period, whether it be at the end of 8 weeks or at the end of 24 weeks, you have the same headcount that you did at the beginning. So what we're advising, if clients can easily get the forgiveness after 8 weeks, then just choose the 8-week period and be done with it. If it's 24 weeks and the 24 weeks benefits clients or businesses that maybe were closed or had a serious downturn in business and it took a little bit of time to ramp up until today, then that 24-week period becomes a little bit easier to attain the forgiveness.
Okay, so in terms of filing your actual 2020 tax returns, how much, I mean, I foresee maybe a lot of extensions going to happen because all of this isn't completely wrapped up, or, I mean, are they saying anything about that, or are we going to just be able to file
So right now, additional literature came out and saying that the PPP funds that you received is not income to you. So it's not taxable income. If it's not taxable income, then you can't take a deduction for those costs.
Okay.
So you received the $50,000 PPP loan, let's say, and you're going to use that loan to pay for salary, to pay for rent, for instance. Because it's not considered income, you're not allowed to take a deduction. So you're not essentially double dipping here.
Got it. Okay.
Makes sense.
So initially, it's still a loan until it's forgiven. So it should go to the balance sheet as a short-term loan. As it comes off the balance sheet, what we're doing and what we're advising, if you think that you're going to get the full forgiveness, then as you're making these expenses and as you're incurring these costs, it should reduce the liability. So here's, I guess, where some of the boring part comes in. It's not a profit and loss item, it's a balance sheet item. So you're not going to be able to take the deduction for it. Now, this is where it will go into possibly next year, and where your question is, how will it affect 2020? If you're filing your return and you're not including the expenses, if everything is going to be forgiven, that is the proper treatment. If for some reason some of the expenses are not good expenses, if the bank and then the SBA afterwards deems that you spent money that you shouldn't have, the allocations were not correct, then you would be able to take the deduction. So there will be, you either will have to file an amended return, you will either have to file an extension to wait until the full amount is forgiven, Or if you feel that you've done everything right and the full amount will be forgiven, then you can file accordingly. So there will be many complications, and there are a couple different avenues which you can pursue and how you really want to tackle it going forward with your 2020 return. But there is a time lag between you applying with your bank, the bank applying with the SBA, and then the SBA making the final determination on whether or not it is or isn't going to be forgiven in full.
That was pretty clear.
That
was excellent.
That doesn't sound as bad as murder hornets.
No, not as bad.
No, and I think those disappeared actually already.
Oh, thank goodness. Oh, that's some good news.
There you go.
There's some good news for 2020.
Yeah. Aaron, is there anything that we maybe have missed about the PPP or anything like that we maybe need to cover, or any other insight before we move on to, because I want to talk about payroll taxes and the companies being able to withhold and deduct and all that good stuff. But before I, get the cart ahead of the horse.
Another sexy topic.
Another sexy topic.
It's very, I think, again, as long as you have all of your documentation in order, there's no secret as to what they're going to be looking for. If there is further legislation.
She's asking me if I have my stuff in order. Did you just hear that?
I heard it, but we know the truth. We know the truth. If there is additional legislation that's passed that says loans at $150,000 below are automatically going to be forgiven, then things get much easier.
We're good.
But other than that, as long as all of the documentation is in order and it's in place, and you run your calculations about what is and isn't forgivable, and you have your head count items appropriately there, ignore the passerby. My lovely wife.
Anna Claudia, we love her.
As long as all of the paperwork is there, then you should be fine. At this point, a lot of the guesswork, in some senses, is out of the equation because you've had your payroll. It's either well been 8 weeks or you're very closely to approaching that 24-week period. So everything should be in order.
Okay. So I took your advice on our podcast pretty seriously when they were talking about just deferring regular payroll taxes. And we had discussed if you go ahead and defer those payroll taxes, and let's say something happens and you don't make it through the whole COVID-19 and you're done, you still are personally responsible for those taxes. So that's kind of when I started reading a little bit about the companies that are going to go ahead and try to help their employees by allowing them to defer some of their taxes that get taken out of their check weekly, biweekly, that I learned very quickly that they're going to start collecting for that come January 1st.
So even if your business went belly up, I mean, it's better to do that now because you're liable for that, right?
This is something different.
So they're two different, you're actually talking about
two different things.
Okay, thank you.
Part of the Relief Act was a payroll tax deferral at the employer level.
Right.
So the employer could defer the payroll taxes that they need to withhold for the employee and pay those at a later time. To your point, both payroll taxes and sales taxes owners are personally responsible for. So if you were to defer it, like you alluded to, if you didn't make it out of COVID, you as the owner would still be on the hook to pay those payroll taxes. The second part that you were talking about, which you don't want to do. The second part of what you were talking about was actually a payroll deferral. So the payroll deferral was really just an executive memorandum. It's not tax law. It wasn't a bill. It was really the president just kind of signing a piece of paper and saying, I declare that there is a payroll tax deferral at the option of the employee. So this is actually the employee side.
Okay.
To me, this represents nothing more than a gimmick. You, as an employee, you could defer your payroll taxes for September, October, November, December, not pay them, get extra money in your account, extra money in your check, and then you have to start paying that back in January, February, March of next year.
Yeah, no.
So it's nothing more than a short-term loan. Cosmetically, it's a nightmare because the employer tax and the employee tax is managed by the employer and done through payroll. So if my employee elects to have the payroll tax deferral, and for the next 3 months, there are no payroll taxes taken out on their behalf, The employer is still responsible for paying their share. This is just the employee share that can be deferred. Now, let's say January happens and we let the employee go, or the employee quits. The employee decides to go someplace else. What's the mechanism now to essentially reclaw those payroll taxes that were deferred? There are no more salaries that this person is paying. So how would one collect that amount that's out? And if it's one person, if it's 1,000 people, I mean, this could seriously jeopardize the viability of Social Security, which is already kind of on the brink, you know, from a funding standpoint. So again, most companies are actually not participating in this, if you will, because it is looked at more, again, to me, as a gimmick, a political, I think the technical term is shenanigan, you know, in order just to get, in order to get more money in my check today, thinking that the economy is wonderful, therefore here's my vote. Practically, I think it's going to be a mess. There really is no benefit in a 3-month loan, essentially, where, you know, I'm going to have extra money today, but now I'm going to have to pay it back January, February, March, in addition to the other taxes that are due. So I'm effectively getting much less money then. So, you know, we haven't seen many companies that are actually using it. You know, it's there. The employees can opt for it. You know, if the employee opts for it, I think the employer is pretty much obligated to carry through with it. But I don't think it's anything that is really a viable tactic.
Yeah, I agree.
To save money, because again, it's not a cut, it's a deferral, and the deferral is really only 3 months.
Yeah, not worth it to me at all. Do you have any? So let's talk a little bit about the interior design industry right now. Strangely enough, and maybe counterintuitively, it's picking up for interior designers. I've had so many interior designers on the Facebook messaging groups, et cetera, come to me and say, man, I've never been so busy. And I have a theory that a lot of the travel budget is going towards renovating your home, because people have been stuck in their homes and they're really sick of it. And it's actually more than a theory. That's actually how clients are coming to me at Darla Powell Interiors. And by the way, I was remiss. If you guys have questions, at the bottom, you'll see questions. Go ahead and add them. And now there will be an opportunity at the end to ask questions. So a lot of interior designers are hiring right now. And they're hiring in a virtual realm, a remote realm, because one of the biggest products that are gaining popularity right now due to COVID is e-design. So I could be an interior design firm, Darla Powell Interiors, shameless plug, in Miami, Florida, and hire an e-designer in New York City. So I would like to know, how do you go about, what's the best way to hire a designer like that in that circumstance? Is it better to hire them as an independent contractor and do a 1099 situation? Is it better to hire them as a full-time employee or part-time? What would you recommend?
I know that answer because I'm the payroll girl, but you're the expert.
So then you can ask the questions and check my math. You can check my math. Go. Better is a relative term. So I wouldn't necessarily say one is better than the other. It's more how you have to categorize them, either as an employee or an independent contractor. So I think that's the first hurdle that you would have to clear. So those that are old enough to remember Choose Your Own Adventure books, that's kind of what we have to look at and look for. Does that mean you are old enough to remember the Choose Your Own Adventure book?
I'm really old.
So essentially there's about a 25-factor test on what determines whether someone is an employee or an independent contractor. The biggest factor is usually control. If you control what they do, when they do, how they do, you set their rate of pay, they're an employee.
Okay.
If they happen to have a separate entity, if they are a freelance designer by themselves and they help out, you know, a bunch of other companies and a bunch of other interior designers, and they do the same thing that they're doing for 3 people, and they send you an invoice that has their name, then they can be an independent contractor. So the main difference from a tax standpoint is payroll taxes. As an employee, you pay half of their Social Security, half of their Medicare, and unemployment insurances, both state and federal. And as an independent contractor, you don't pay anything. So you would have to look at what your business model is, I think, first, and determine, are you better off with an employee, whether it be part-time. The other thing that we run into a lot is I'm only going to hire them for 5 hours a week.
Okay.
That doesn't mean that they're not an employee. So it's not the length of time or the amount of time that they're working what distinguishes between an employee or an independent contractor. It's more about the control. So if you determine that they are in fact an employee of your company and they have an email address and you're telling them what to do and how to do, the true cost is about 10% more, let's say.
Okay.
When you factor in payroll taxes, possible payroll expenses. So if you're paying somebody $50,000 a year, your true cost is going to be $55,000 a year. And again, with the independent contractor, if you pay them 50, that's the expense. It's only 50. So I think the other hard part in a virtual world is hiring the right person virtually.
Yeah.
You know, typically with an interview, you get to see somebody, you get to shake a hand, you get to get an idea as to how they work. When you do it online, it's very difficult. So I would say hiring online, be very, very careful. I mean, scrutinize referrals and recommendations and, you know, again, check your math. Make sure you're hiring the right person because there's a lot less control when you're virtual. Very busy hallway.
I see that. She's very speedy too. Okay, so one thing that you did mention there, pardon me, that I think is very important to point out is that they actually do have to have, in order to 1099 them, you cannot be their sole client. You can't, there's no loophole, right? To say I'm the 1099.
Not necessarily. You can have like your one whale client that you only have one. But if you, as the, let's say, as the independent contractor, have set yourself up with a business, you have an entity, you have a business bank account, you have a website, you have business cards. Again, it's not so much I have only one client or 50, but if it's that one client, I, as the independent contractor, telling you how much you're going to pay me, as opposed to vice versa. I'm telling you when I'm going to work and how I'm going to work.
That's good to know, and I'm glad I asked that because I'd actually heard the different. I heard different than that you know, if someone had to show that they had several clients on a 1099 kind of situation, or the IRS was going to Powell them, as we say in Miami, that Powell. Give them a Powell.
No, I don't think that they do much Powelling. Again, it's not so much only having one. It's more that control element.
Okay, and yeah, I prefer the control myself. Yeah.
If you prefer the control, if you're telling them, again, you're going to work on this project, not so much creative control.
Yeah.
Because people worked it, but if you're going to say you're going to work on this client, when you go to this client, you're going to have your Darla Powell's t-shirt on, you know, you're representing our company, they're an employee.
Exactly. I like that. And, you know, it's more of a logistic control and a branding control, and that's important. Creative control, I'm pretty good with that for sure. So and before we move on to the next thing, another thing to keep in mind is if your interior design firm is in Miami, Florida, and your remote e-design hires in New York, you're paying New York payroll taxes, right?
So this is a very big area that is going to get a lot of news and a lot of scrutiny this year, specifically because of COVID. Exactly, specifically because of COVID and a lot of temporary moves and temporary housing, and COVID itself being a temporary issue. The person that is working for you, even though you're a Florida company, the person that is working for you in New York is going to pay New York State, and if they live in the city, going to pay New York City income taxes on all of their earnings. So if you have an employee there that is a permanent employee there, then yes, you would be on the hook for, let's say, for New York State unemployment insurance. Because if you have an employee that is working in New York and you fire them, they would be eligible for unemployment insurance. And I would say this is actually, and that is actually the number one reason that people get caught with an improper designation. So if I've got people that are on 1099, I fire them, they call up Department of Labor and they say, I want to apply for unemployment insurance. Department of Labor says, we have no record of you. We have no record of you being an employee, and we have no record of payroll taxes being paid, and we have no record of unemployment insurance being paid. So, you know, part of what we were talking about earlier, it really is, there is a risk element of, you know, how you want to categorize them or classify them. But that is one of the biggest issues of how it is essentially uncovered, if you will, from an audit standpoint. But back to your question, if you have employees that are in other areas, in other states, then yes, you would be responsible not for the income tax that they're paying. Payroll tax is a federal tax. So wherever they're working, whether it be in Florida, in New York, in California, the payroll tax of Social Security and Medicare is federal. So that you're going to be withholding for them anyway. And then their state income tax, you don't pay, you just remit on their behalf.
Okay, do you get it? Do you understand?
Yeah, I have a bookkeeper. I do. They take care of all that for me.
That should be your first hire, by the way. If you're an interior designer, is a bookkeeper, and
That's
then
right. Get a good bookkeeper.
A good sexy tax guy.
A good sexy tax guy, a bookkeeper and a tax guy.
Okay.
They're much better than boring tax guys.
Well, I think before we talk a little more about residency, I think we should talk sometimes. I have to correct Darla all the time about the misconception of what can and can't be written off for taxes. Darla thinks that, her whiskey can be written off. No big deal. I need it for, part of the brand. And so my question is, and I kind of want to complicate it maybe just a tiny bit if I could, because when you write off for taxes for a home office, you can do X amount of percent for the electricity. Maybe you want to charge your company rent, maybe, whatever it is that you can write off and get away with writing off without without causing any red flags for an audit. There is set numbers and set percentages that you can write off. How will that go against the PPP loan if you're writing you're not going to be able to write any of that. If you use your rent payment to pay yourself, then you can't write it off.
Right. So there's a lot to unpack there.
Okay. I'm already lost.
I know.
The home office deduction, it's not an arbitrary percentage or an arbitrary number that you are allowed to deduct. The way the home office deduction works is essentially the room has to be used exclusively as an office that you're using.
Square footage, right?
So, and then the square footage test, correct. So in New York City, if we're in a 500 square foot studio, your bathroom is here, but then your kitchen is your living room, is your bedroom. If you're saying the corner over there is my office, it's not impossible to take, but it is a little bit harder to take the home office deduction. The true spirit is if you had a 2-bedroom apartment and one of the bedrooms was an office, or if you have a 5-bedroom home, one of the bedrooms is an office, that's your home office. The way the deduction works is the square footage of the office divided by the square footage of the house or the square footage of the apartment. So very simply, if one of the rooms is 100 square feet and the house is 1,000 square feet, you could deduct 10% of your rent, of your mortgage, of your real estate taxes, or of your utilities. Okay, so again, it's not just like a random number that you're picking. For the PPP, if you took a home office deduction with the PPP, that can count towards the rent that you're able to use as part of that 40% of deductible costs. So rent is a good expense with the PPP. If you paid rent to a landlord, that counts. If you had a home office deduction on your return, that would count too. Okay?
Clear?
Sure.
Clear.
What I'm hearing though most of all is that I can't deduct whiskey.
We haven't gotten to the whiskey yet.
Oh, okay.
We haven't gotten to the whiskey yet. This was just the square footage. This was just the home office part.
Gotcha.
The rule to deduct expenses is if it's ordinary and necessary, and if you need it for the business, essentially. And that's very gray. And different industries, certain expenses are deductible for one industry, whereas they may not be deductible for a different industry. If you're using your whiskey for a photo shoot, if you are doing a podcast with somebody and they happen to be a purveyor of whiskey, you could say that the whiskey that day is particularly needed for that podcast and therefore would be deductible. Clothes are another issue that, depending on what industry you're in, can be deductible. Suits are not deductible. Anything that can be used for ordinary use is not deductible. And so like the dry cleaning of the suit is not deductible. If you had a mascot uniform that you had to buy, that would be deductible because you're not really going to walk into a restaurant with a mascot uniform on.
We can wear chicken suits.
You are it may look good, but you can't really, use it that way. So If you are a model, if you are a personal trainer, you could make the argument that I'm going to deduct my gym membership because as a personal trainer, I need it for work, and as a model, my appearance matters. If you are an accountant, you can't deduct your gym membership because it has nothing to do with the job that you're doing.
What if you're a sexy accountant?
Then the mirror could be deductible, but the gym itself may not be. So it depends on what industry you're in. Auto expenses, telephone expenses, anything that can be used for business. Meals, entertainment is no longer deductible. Meals are still 50% deductible. Various travel obviously is still deductible. So there is an element of gray with what is and is not deductible. Some people have a very high tolerance of what they're going to deduct. You know, there may be a very large audit risk for that. And if the deductions are deemed to be not relevant to the position, not relevant to the job, they're disallowed, then you would essentially still owe the tax and owe the interest. But if you're doing it by the book, anything that could be attributable to the job that you're doing, you know, with your podcast, other web expenses are deductible. Research that you may have to do for a client, again, this is where the whiskey is going to come in. If you have a photographer on, you know, certain camera equipment could be deductible. So again, it really does depend and is specific to what you're doing. In most cases, now, you know, again, office rent is office rent, right? That's pretty black and white. It's the gray area of each industry, what would determine what is and may not be deductible.
Okay, so what if
you
own
no, the whiskey is deductible, right? We already got the whiskey.
We got
We're good with the whiskey.
I just have a quick question to follow up on that, and then we'll get into the residency thing, which is the sexiest.
We saved that for last, yes.
So what if you do public speaking in an event and you purchase clothes, particularly not a mascot, not a chicken suit, not a wingnut suit, but just clothes specifically for that you don't really wear anywhere else? Is that deductible?
The fact that you don't wear it someplace else doesn't mean that you can't wear it someplace else. Okay. I would say a wedding dress would be, because you're really not going to wear a wedding dress, you know, other than one time, or if it was for that one speaking engagement. But a cocktail dress, a blouse, again, a suit, something specific to that would not, you know, again, by the book, be deductible because you can wear it tomorrow.
Okay, we have a question down
here.
So
keep the tags on those last clothes that you just bought.
That's classy. You don't want to go to the Q&A there, Nat, where it says Q&A, because we do have a question.
I am.
All right, there's a question. Anonymous attendee. Ooh, mysterious. Hi all. Okay. Sort of unrelated, but if I have kids learning from home now because of COVID, can I claim school-related expenses on my taxes?
No, because you are not a teacher. So there isn't anything that you would be able to deduct. Personal expenses by nature are not deductible. So, you know, you would argue that now if you were a tutor, and this is actually a perfect example is what we were just talking about. If you are a tutor, then yes, any games, puzzles, teaching supplies would be deductible because that's the trade or business that you're in. If you're a parent and you're just buying additional items, those are not deductible.
Okay. Okay. I hope that answered your question, mysterious anonymous person. All right, last but not least, certainly not least, the sexiest topic of all, residency.
And Darla has no idea and does not even understand how this works.
Listen, I understand things sometimes very well. Sometimes it has to be explained to me a few times. So this will be what, the third time, Aaron? Go, Nat.
Yeah, go ahead, Aaron.
Well, third time's a charm. Say, right? So again, because of COVID, residency issues, I think, are going to be very hotly contested. Specifically and very localized, if only city residents, New York City residents pay New York City tax. So if you were out of the city and not considered a city resident, then you wouldn't have to pay city tax. If you were in New York and then you went to New Jersey or Connecticut or Pennsylvania because you wanted to escape the city, you wanted to go to a mountain house, you wanted to get away, the idea is that you wouldn't have to pay New York State taxes because you're not considered a resident in New York State. So globally, you pay taxes on a worldwide basis wherever you live, where you're considered to be a resident. Residency, though, has a lot of issues where permanence and intent matter. So COVID is a temporary, I mean, hopefully not, not much longer but it is a temporary issue that everybody is dealing with. So if you move temporarily out of your house and you went to another location and you were working remotely, because people are allowed and most people are working remotely now, the question is going to be, where are you going to pay tax? Federally is federally, but what state are you going to pay tax in as a resident?
That's complicated.
Where you moved out of, again, temporarily, or where you have more ties, where your dog is, where your pictures are, where your Us Weekly subscription goes to. So that matters. And because this issue kind of started February, March, people have been possibly out of their primary house for quite some time and now living in a secondary spot. So with most state jurisdictions being pretty broke, given what's going on, residency issues and residency audits for this year are going to be very highly scrutinized. Where if you were a resident of one state last year and now this year all of a sudden you're not, and you still have New York source income, meaning you're still working for your employer allows you to work from home. So you're going to get a W-2 that's going to show, and I'm only using localized examples, but it's going to show New York withholding. But if you went to Cape Cod for 9 months because you had a family home there or you rented a little bungalow, whatever the case may be, the case that you're going to make is, I wasn't in New York for the whole year. Residency from a day count standpoint is usually 183 days. So if you are in an area in a state for over 183 days, you're determined to be a resident. One of the factors, okay? So now if we're out for 9 months, and 183 days is usually 6 months in a day. So, water cooler talk, I'm gonna move in, I'm gonna make sure I live in Florida for 6 months in a day. And that's kind of why you hear that, for the residency purposes. So if the intent, and intent is also very hard to prove, but if your intent is only from a temporary basis, then that temporary home that you're living in is not going to be considered your residency. And you're still going to be considered a resident where your permanent fixtures are.
Where your dog and your Us Weekly is.
Okay.
Correct.
Even if you're at the other place for 6 months in a day.
Correct, because at a minimum, there are things that need to be, voter registration change, driver's license change. Mm-hmm. They will look at credit card receipts. Where are you buying your gas? Where are you buying your groceries? Really? Where are your kids going to school? So, a lot of this also happened during summer initially with COVID, and now a lot of schools are still remote. So again, if people are saying, well, I haven't lived there, my kids aren't in school, but where are they going to go back to school? Once school starts up again, are you going to go back to that apartment or house that you own? Is that considered your permanent residency? Or are you considering your permanent residency to be where you are temporarily living today, even though you're out of the area for 183 days? Hmm. So again, permanence matters, intent matters, and it's going to be very highly audited, I would say, this year. Given everything that's
that was my next question. How close attention are they paying to this? What is the accounting for this? Because I know somebody who's been here from Virginia for over 3 years and still has a Virginia license plate, still has a Virginia driver's license. I don't know what kind of tracking there is on this kind of thing. Is it really robust? Are people going to be able to sneak by or don't even risk it? Well,
like you said, they've been there for 3 years. So, do they have a home there? Do they live there? Is their job in Florida?
Yeah, all of it.
It's not, all of these factors that I've mentioned, they're not looked at solely and isolated. Driver's license doesn't expire for years. So you could get, your driver's license today in a particular state. You could move 3 years from now, but the driver's license is still good. No need really to get a new one, practically speaking. Voters registration though, are they registered to vote in Virginia or are they registered to vote in Florida now that they have a home here? So it's not one thing here makes you a resident and lacking of changing your driver's license does not make you.
Okay. I'm just curious about that. And actually in Miami-Dade County in Florida, you have 10 days to change your driver's license or you get a ticket. I know that because I used to be a...
From when it's expired?
No, from when you move.
When you move.
Or to change your address. on your, because I used to be a cop.
Okay.
So I just happen to know this is useless facts. Okay, I think we're rounding up. I think we've pretty much covered anything. Is there anything else now that you can think of? Or Aaron, do you?
Aaron, anything you think that's more sexy that we haven't covered?
Related to this topic, I don't think so. I think we hit the highlights, but I will say we are approaching year end. We are coming into the fourth quarter. So, people should really start looking about closing their books. What am I looking at next year? What are my tax obligations going to be? Make sure that, again, the bookkeeping is up to date if possible. You don't want to really be doing in 2021, 2020's books. So it's easier to get ahead of everything. And I would say, given that we're in the middle of September, or the tail end of September at this point, coming into October, the year will be over before we know it. We are all dealing with an incredible amount of issues personally, politically, business-wise. There are a ton of distractions. So I would just not wait to the last minute and get those items in order.
All right, sounds good. So at this point, guys, if you have any more questions that are sexy tax related for Aaron Smyle, please shoot them at the bottom of the screen. Other than that, Andrew, I think we're set. If there's no more questions, or Kelly, or somebody.
Hello, does this work?
Hello, is this thing on?
Right, exactly.
Well, okay. Well, what else we got? I feel like, hey, hello, my honey. Hello, my baby.
And she's not even drinking whiskey, Aaron.
Not yet, which
Not
could
yet.
be tax deductible.
It could be.
Okay. Oh,
Depending
okay. I
on
do
who
have
your
another.
next guest is.
All right. So, okay. Well, since they're not chiming in, I do reference the whiskey when we do. Oh no, I don't mind at all. Reference the whiskey when we do events. It is part of our brand, and Natalie will bring it. And people come up asking for whiskey, High Point and stuff like that. Is that considered deductible?
Yeah, if you're having an event.
Okay.
Then the drinks and the food that you're bringing to that event would be deductible.
It would be, yeah, even if we're not hosting the event.
I'm sensing a theme. No, if you bring it in a flask, that's not deductible. But if
that's what we do.
There you go.
Yeah.
All right, guys. So that's it. I would like to thank Aspire for having us here. Andrew's having Wi-Fi issues, so I'm going to dance us out. Aaron Smyle, thank you so much for being with us today. And thank you, guys, if you want to learn more about Aaron Smyle, he's been on the Wingnut Social podcast twice now. He's already a veteran. Aaron, please tell them a little bit more about where they can find you, and we will bid them adieu. Sure. You can look at us and find us on Instagram at Smyle Taxes, SMYLE. You can find us online at smylyassociates.com. Any questions, please feel free to reach out. We're more than happy to help. All right. Thank you, Aaron. You can learn more about us at wingnutsocial.com. Please check out our podcast. It is also sexy and full of information for sure. And whiskey. And whiskey. And we drink whiskey. And Little Debbie cakes, yes. Quite a lot. So thank you all for coming. We hope you learned a lot, and have a great week and have a great weekend. Thank you, guys.